Okay, now move to ACCA F9 course, the 6th class. And today we will go through 7 topics in risk management. We are focusing on 2 risk management. The first one is exchange rate risk. The other one is interest rate risk. And today, for the first topic we'll discuss is on the main instruments for managing exposures. We will share with you the instruments to managing the risk for interest rate as well as for foreign currency exchange rate. Next, we move on the term structures of interest rate. Okay, for interest rate, there are 3 theories shared or stated in the ACCA F9 syllabus. And we will talk about those theories and also explain the term structure of interest. Okay, this part you should be very careful because it is not an easy question to examine students' knowledge in the examination, but it is quite often for the ACCA F9 exam to have a question asking students to answer term structure of interest rate. Next, we move on to the theories of exchange rate determination. We have 2 equations. We have 2 equations in the formula sheet about the exchange rate determination. So we will go through it, and then we will move to the foreign exchange market, and coming back for the hedging foreign exchange risk, as well hedging interest rate risk. Okay, we move on to the first topic, which is the main instruments for managing exposures. So once the exposures, no matter it is interest rate or foreign exchange rate, the exposure is identified, and then we need to choose the appropriate method to manage those exposures. So what are they? Okay, financial instruments, we are talking about the interest rate first. There are several instruments that we will discuss. And in general, those instruments are forward, futures, options. Okay, here is the hedging instruments from external party. All right. So first of all, we talk about interest rate. We talk about the forward rate agreements, which is the FRAs. It is the agreement negotiated and concluded between a bank and an organization on future interest rate for the borrowing or lending. So in other words, it is a agreed interest rate that an organization has to pay to the bank on the funds they borrowed. Okay, so it's just a forward rate agreement. So agreement between 2 parties agree the interest rate now. Next is the interest rate futures. It is an agreement to buy or sell a standard quantity of bonds which will be satisfied by the future exchange. So it is different from the FRA, the forward rate agreement. It has the standard terms and standard quantity. Okay, and the futures are traded in the exchange. Traded in the exchange. So remember, for the forward, okay, it is only an agreement between the bank and you. So it is not traded in the, for example, in the exchange or in other market, in an exchange market. But for interest rate futures, yes, it can do it. And the last, and here is we talk about options, the interest rate options. Be careful. You have to differentiate between futures and option. Okay, for future, it is your obligation to commit. But for option, it's the right, but not obligation. So in other words, you buy an options, it means you have the right, to exercise it when it is in favor to you, but you can just leave it out and just losing your premium paid before. But for future, no matter how much that you are losing in the position, you have to pay for it. So for the options, it is the contract gives the right to buy. For example, call option. Call option is the right to buy. It's the right to buy an asset. And put option is the right to sell interest rate futures. Okay, remember the underlying asset of interest rate options is the interest rate futures. With no obligation to carry out the contract. Okay, so OTC means over the counter. Over the counter interest rate options give the rights to future interest rate. So here we are talking three instruments: forward rate agreement, interest rate future, and interest rate options. And the fourth one is the interest rate swaps. Okay, swaps means exchange. So what does the interest rate swaps mean? It is, in your notes, it states that the agreement between two parties to exchange interest rate payment, meaningfully only a fixed rate payment for floating rate payment. So how does it work? For example, for swaps, there's a party called A, and here is a party called B. Okay, for A, it has 1 million principal. For B, exactly the same, 1 million principal. But for A, it is a fixed interest rate, at 5%. But for B, it is at floating rate, say 1 month LIBOR plus 4%. So for the interest payment, so because they are the same in the principal, both are 1 million. So the difference between these two loans for A and B, these two loans, for A and B is the interest. For A is paying fixed rate, for B is paying floating rate. But for A, it is expecting the interest rate will fall. So the expectation from A is the interest rate will fall. But for B, it's in the opposite view of the interest rate. It is considered the interest rate will go up. So they found a bank or intermediary, and the bank just matched two parties and found a solution is to exchange or to swap the interest payment. So for example here, for A, it paid a fixed rate to the market, right? It paid a fixed rate to the market. So right now, it would like to change it, the position. It would like to pay floating rates. It would like to pay floating rates. So it will negotiate with the bank to arrange a swap. So finally, it can pay a floating rate. Okay, the arrangement is A receive fixed interest income and pay floating rate interest. So here, right here. So for A, you pay to bank floating rate interest, but receive fixed rate income. Okay, and for B is the opposite. For B, it will pay fixed rate or fixed rate interest expense to the bank. In return, it will get the floating rate interest income from the bank. So the bank as an agency, it helps to match or to link with A and B. And for this topic, we will go through in details later on for the swaps. Okay, it is the exchange of the payments. Remember, the key here is to exchange payments. All right. So for foreign currency, we just mentioned about the interest rate instruments for managing the exposures. How about the foreign currency? Okay, for foreign currency, first of all, you have to identify what types of the exposure are required to hedge. Okay, remember, we have the translation exposure, we have the transaction exposure, and we have the economic exposure. So in general, what kind of exposure that we need to manage by hedge? Is transaction exposure, right? So managing transaction exposure. The amount of exposure is known and thus may be managed by the use of financial instruments. So in other words, for managing the transaction exposure, because as we mentioned in last class, the amount of money that we know it, and also the period, and because the risk identified for the money, the amount itself as well as the period itself. So because these two variables that we know it before, so we can manage this exposure. And we have three different methods. Okay, I would like to say we have internal and external methods. We have external and internal methods. And here, we are talking about some internal methods here. For example, invoicing in home country. It is easy. For example, if I'm a British company, I just send out the invoice or issue the invoice in British pound. Then I have no foreign exchange risk. Okay, all the risks will transfer or pass through to the consumer or to the customer. So it's the first method. Okay, suppose your company has a very strong bargaining power. No matter it is your supplier or your customer, you can bill the invoice in your home currency, like for example, British pounds. Also, you can force your supplier, even if it is an over supplier in overseas market, you can force them to issue the British pound supplier contract or invoice. So it depends on your negotiation power and bargaining power. Second is netting. For netting, it means the exposure can be netting off by the receipts and payment in the same foreign currencies. So in general, netting is for some intercompany transactions. Okay, for intercompany transactions, because you know it, okay, you can match it, then you can just say, for example, paying the net difference is fine, or you have the customer and supplier in the same country so that you can arrange a netting for the receipts and for the payments in the same country so that your risk exposure in foreign exchange rate can be minimized as well. It's talk about netting. And leading and lagging, okay, it is simply just say you can, for example, pay in advance. For example, lead is pay earlier and or pay later, for example, lagging. So that you can manage the exchange rate risk by looking forward any exchange rate movement in favor to you, then you can shift your strategy from to leading or lagging. Okay, but in general, it is mostly used by the intercompany transactions because you, for example, if you are the supplier of the customer. Your customer is happy to delay the payment to you, but if, for example, if you would like to say leading, I would like my customer to pay me earlier, then your customer may not be happy to do it, and it may affect your sales as well. So it's mainly for the intercompany transactions. And also we have external methods to manage transaction exposure in the foreign currency. It means external methods. It means you have to go to the bank or other financial institutions or agencies to help you to arrange the instruments. Okay, we have 5 instruments here to be shared. Forward contracts. Forward contracts, okay, it is an agreement but with bank to buy or sell the foreign currency at a fixed exchange rate agreed with you at some future date. Okay, so for a forward contract, it is very similar to what we saw in the interest rate. Okay, it is an agreement with you are committed. You're committed, and you're committed to pay or to buy for the underlying asset, which is both parties agreed on the terms. And second is about the money market external method. Okay, for money market, it is okay. First of all, what is money market? Okay, money market means a liquid market by selling or buying the instruments of financial asset. Okay. So for money market, you have to identify something first. You should know your position. You are receiving foreign currency or paying foreign currency at the future date. Okay, so the position first. Receiving foreign currency or paying foreign currency. Okay, it's very important because if you forget to set the right position, you will make wrong steps, also the wrong answer. So you have to identify your position is whether you are paying foreign currency at future day or you are receiving foreign currency at a future day. And for third point is currency futures. It is similar to forward contract, but the currency futures are the standardized product in the traded or in the exchange market. And for currency options, the option holder has the right to an exchange rate. It means the exercise price for buying or selling of standard amount of currency. So it is also, we said it is the right, but not an obligation to do it. The fifth is currency swaps. It is a bit similar to interest rate swap, but interest rate swap is the local currency swap in the interest payment. But for currency swap, it is the swap between two currencies. It means, for example, here, A and B, they would like to exchange the currency hold for the other currency. For example, A would like to change 1 million pounds to the US dollars, and for B, he or she would like to change the $1.4 million to equivalent pounds. So in this case, okay, they will find a bank. They will find a bank, and the bank help to line up with each party. Okay, so here, both A and B, they agree the interest rate, period, and also the exchange rate. Okay, so for the A and B, they have agreed the terms, including interest rate, period, exchange rate, for the notional amount. Here, what we call it, this is the notional amount. Okay, so the two companies has to agree with the bank on these terms, and then they can change the payment or the swap, the interest rate payment or the interest payments, and principal. Okay, the principal. So the key here I would like to stress is for the currency swaps is quite similar to the interest rate swap, but in the interest rate swap there's no need to change the notional principal. But for foreign currency swap, it finally will change the notional principal to the different currencies. Okay, so we move on to next is the foreign currency about managing economic exposure. As we said, economic exposure is long term, and you cannot identify how much will be affected now, because there is a directional impact or change in the business. So for managing economic exposure, the uncertainty in the amount of exposure, external financial instruments will not likely be used, but internal methods will usually be used in managing this exposure. So what type of internal methods will be used? For example, diversifying the suppliers and customers worldwide. For a very big company, they can do it. Okay, for example, their suppliers may be all across from Africa to Asia to Europe and to America. So they diversify the suppliers and also as well their customers as well. So it can help them to minimize the exchange rate risk. Also, you can diversify your operations worldwide. Okay, not only the suppliers and the customers, you can also diversify your operation into the other countries in the world. It can help to minimize your economic exposure as well. And next, we talk about what what are the factors affecting to be considered in managing exposures? First of all, risk attitude. Risk attitude, okay, is the important part. What's the company attitude to the risk management? Okay, any company policy stating that no individual transactions can be submitted or can be processed where it is relevant to the foreign currency, okay, unless it can get a blah 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 approval. So any company policy on the risk management on the foreign currency, okay, it is one part. Also, we need to check the risk exposure. It means the amount and volatility of rates. Third, internal methods available. Okay. For example, we just mentioned netting. We just mentioned some of the invoice in the home currency, and also the leading and lagging. So all these internal methods are available or can be used in the upcoming seasons, for example. Expertise, okay. Any internal profession managing financial instruments is very important. Okay, if none of the staff understands what is financial management, including the capex, including such like right now the case, if we don't have it, then it is quite challenging to implement this exposure management task.